My name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens, but only just, again. As I said last week here, I'd noticed two new possible patterns, not necessarily complementary. The first is a mid-June to date possible ascending triangle. Okay, strictly speaking, the flat top side trend line is capped by the resistance at 1459, whilst the rising mid-June to date uptrend, currently 1338, is the lower rising trend line. That is it, strictly speaking. However, I would also look closely at the rising long moving average, currently at 1349. It's a possible dynamic contender for the rising uptrend, or at least an influence. Likewise, the flatlining more or less medium moving average, currently 1441, could be seen as a dynamic contender for the flat topside trend line, or again as an influencer. Whatever you choose, I would look closely at the action of both of these moving averages, especially when the market is near, as they may give an early warning. Now, a few words on ascending triangles. They can break either way. However, they tend to break upwards something like 7 out of 10 times. I'm not prepared just yet to give some numbers on the size of the move, not just yet, but I wanted you to know what I saw. The second possible pattern is also related to recent events, but from early June to date. This time we take the core action that forms the ascending triangle and include it in part of a possible bearish halfway hesitation, along with the action from early mid to mid-June, making the left flagpole. Now the market hasn't started forming the right flagpole, not just yet, but this is an overtly bearish pattern as opposed to the earlier one. Indeed, you could actually extend the left flagpole out to the high of the market back in May, but I personally think that would be stretching it a bit. Again, I'm not happy just yet to give any targets on this on the downside because it is too early. However, I wanted you all to also know this potential pattern as well as the ascending triangle. Now, these patterns are what is driving the current market. So since last week, what else have we seen? Well, basically mainly nothing. We saw a bearish black crow last Friday, which initially followed on lower last Monday, but the move back down ran into not only the rising long moving average, but also the Fibonacci congestion at 1343 and 1333, and then stalled before testing the uptrend before reverting back up. The following two sessions were also indecisive patterns, and it is seeming only really today that we've had an attempt higher, though that may change obviously. Overhead we have now resistance at 1392 and the recent 50% Fibonacci line at 1405. Now above this I note the dead cross of the short medium moving average down through the medium moving average. That happened early this week, but it's not really had an impact as yet, and it's a lagging indicator anyway. Chicago soybean meal. I wrote some 5 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. During June, the market broke down through the long moving average, currently 40070, and dropped down to the lower time, currently 324.90, of the bearish 2021 Andrews pitchfork. Then there's target X below in the 337.30 area. I think I'll better reprise my commentary again from 6 weeks ago to better explain why there's a target X down there. I quote, "The next is a little bit unsure and a little bit out there, but I'd rather say it and look a fool now than a bigger fool later. Should it happen, it is to regard the whole action from the high in May to date as a possible bear flag come bearish halfway hesitation. I'm the first to admit it is far from perfect, but if we look at it, we do have a possible pattern there, and with a possible target X on the downside of the 337.30. Like I said, I'd rather look foolish now than later," and that's the end of the quote. That was then, and this is now. Prices came very close to target X at the end of June, but was stalled and diverted back up by the declining lower time. I'll keep target X on there for a bit longer. I just think it may have some relevance. Since that drop, prices have pinballed in between the lower tine and the middle tine, currently 371.20, with the 50% Fibonacci line of the August 2020 to January 2021 move at 376.70 and the lesser Fibonacci level at 354.30 also having varying amounts of influence. It is at this time that I wish to recognise the wonderful job the bearish Andrews pitchfork has done in channeling the market lower. It was drawn in May and has been useful and valid up until this very day, and perhaps for some time forward. That is the key to the market here, the bearish Andrews pitchfork. When it gets busted or adjusted to a bearish shift pitchfork or some other pattern, then we can look at it for new ideas, but until then that rules the incentive in this market. Since last week we've had an attempt lower, but it has been half-hearted. It started well late last week with two bearish opening black Mariposos, but they stalled at the next session. They stalled as the next session this past Monday turned up into a possible bull hammer action. This in turn saw a small follow-on higher on Tuesday, but then yesterday saw a contrary action, a bearish harami if only just. Since then we've been confused, most recently pushing higher, but in an overall bearish market, I suggest just keeping a look at the tines. They'll work until they no longer can. Chicago soybean oil. The pattern that became obvious over May to July bar the horn top in June is a rather lopsided diamond pattern. I'm the first to confess that it is not a pretty one, more functional than aesthetic, but it is also still there. Now, a few words on this pattern. Diamond patterns can be tops, bottoms or continuations. In this particular case it will be either a top or a continuation. This time last week prices broke down through the lower uptrend of the diamond, currently 66.38, but that was not enough. Admittedly, we had a combined key reversal down on bearish engulfing pattern on Monday last week that triggered the move lower, but we also had 2 days of countering indecisive action at the start of last week before we broke lower. That is why it is worth looking at all breaks as possible false breaks. Additionally, we had a pullback up since then and running into this week, with the market going higher and contraring the original move lower. These pullbacks may also be false by going a while higher, then turning around and restarting the move lower. However, there is a couple of values I can give in case we do have a true break higher. A move lower would be about 10.3 cents under the value of a confirmed break of the lower diamond uptrend. In this case today would be in the 53.80 area. A move higher would be about 10.65 cents on top of a confirmed break of the upper trend line, which we haven't done as yet. But it would be about 77.80 today if we did. A week after the original break lower, and I still haven't assigned a target exit yet because none of it is really confirmed. In the meantime, topside we have resistance at 66.45, which we've been testing just now. That's the diamond topside declining trend line, also as well slightly higher at 67.14. The July 2008 high at 68.13 and the June 2008 high at 68.97. Meanwhile, below we have support at 64.84. Then the dubious moving averages of the short moving average, currently 64.25, and then the slightly less dubious, at least on a closing basis, short medium moving average, currently 63.51, and then the 2011 high at 61 even. However, the real support is a familiar old band below between 57.64 and 59.44. None of this is settled, not yet. But I do note the size of the diamond top does trump the size of June's monthly key reversal up. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.